On Point with Craig's Investment Partners.
The information provided here is general in nature and it's not financial advice. It doesn't take into account your financial situation, objectives, goals, or risk tolerance. All investments are subject to risk and none are guaranteed. So before you make any decisions, we recommend you contact an investment advisor. For more information about our services or to view the Craig's Investment Partners Financial Advice Provider Disclosure Statement, please visit our website, which is craigsip.com. Welcome to On Point. I'm Mark Lister, Investment Director at Craig's Investment Partners, and I'll be talking about a range of topics including economics, portfolio strategy, investor education, and anything else that's happening out there in financial markets. There have been increasing concerns over stagflation risks in recent months as economic indicators weaken and tariffs threaten to push inflation back up. The term stagflation is used to describe the highly undesirable combination of low growth, high unemployment, and high inflation. Recently, we've seen US continuing unemployment claims hit the highest level since 2021, which means that displaced workers are finding it increasingly difficult to find new jobs. We've also seen the ISM indices for both the manufacturing and services sector in the United States fall back into contractionary territory, with new orders slumping. The prices paid indices in these surveys have hit 3-year highs, while long-term inflation expectations in the University of Michigan survey have risen above 4% for the first time since 1993. We've seen similar signs here in New Zealand, with growth still sluggish but some inflation indicators quietly ticking higher. The ANZ Business Outlook survey has seen the net proportion of firms intending to raise their prices increase above 50% in recent months. That's close to the highest in almost 2 years. Cost indicators in this survey have also drifted up, and that suggests that many firms might try and recover those higher costs at the first sign of a stronger economic backdrop. The escalating conflict between Israel and Iran has added further risks to the outlook. Oil prices have spiked 20% to over US $70 a barrel, and some estimates suggest they could rise above $100 if things worsen. Slow growth and rising inflation are an ugly combination, and a sustained increase in oil prices wouldn't help matters. While there's no cause for panic, these indicators do mirror some of the warning signs that we've seen from previous periods of stagflation. The most well-known of these is the 1970s, a decade that was abysmal for investment returns. US shares, corporate bonds, and real estate all posted respectable, albeit below average, annual gains of 5 to 7% per annum. However, none of these kept pace with rampant inflation, which meant that in real terms, investors went backwards. During those years, it was even worse here in New Zealand, with our inflation averaging 12% per annum during the 1970s, outpacing the local share market and completely eroding 10 years' worth of house price gains. Few assets provided refuge, with gold, commodities, and farmland some of the only things that performed well. Several factors contributed to this situation in the United States, including high government spending and wage demands from powerful trade unions. However, soaring oil prices were the biggest factor after oil-producing countries cut supply in the wake of the war between Israel and a coalition of Arab states in 1973. The rising fuel prices hit the US economy hard, leading to higher transport costs, wages, and overall prices. During the previous decade, the 1960s, US inflation had averaged just 2.5% per annum, unemployment had fallen as low as 3.4%, and interest rates had remained modest. But by 1974, inflation was running at 10%, the central bank policy interest rate was almost 13%, unemployment was on its way to 9%, and the economy was in recession. To be clear, the 1970s was a very unique period, and we're a long way from there today, despite some of the recent similarities. However, a milder version of this would still make for a challenging backdrop. There are few winners from a weakening economy, especially if stubborn inflation puts policymakers in a bind and reduces their ability to provide support. A central bank would typically start reducing interest rates in response to slowing economic activity, but if it sees price pressures on the horizon, it might be forced to think twice. It's important to note that many of the negative signposts we're seeing right now reflect concerns on the part of consumers and businesses about the potential future, rather than the actual reality. We need to monitor oil prices. We need to watch and see where the pricing intentions actually translate into higher consumer prices. And we need to keep a close eye on how central banks deal with these conflicting signals. While today's stagflationary risks pale in comparison to the 1970s experience, even a milder version of this would certainly reshape the economic and investment backdrop. Thanks for listening, team. Let's talk again soon.
For more insights, visit craigsip.com.